Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. I do want to say at the start that we listen to you in the comments that you put up on our videos that get posted online. And just a couple of weeks back, we had a conversation about savings bank accounts when a lot of the frontline banks reduced their interest rates on these accounts quite substantially. And we said it's not the best idea to keep a large amount of money lying idle in your savings account. Now, the counter to that, of course, is that investing instead as an emergency fund in a mutual fund is maybe not the best idea in terms of liquidity. Of course, yes, you get the money the next day, but in certain cases, and one of our viewers pointed out that he had a heart attack and his children or his wife did not have access to the mutual fund account. And so they needed money in their savings bank account so that he could be rushed to hospital and the immediate expenses could be taken care of. So we'll talk about this, but I also want to talk about a new category that is catching the eye because of the change in the taxation of liquid funds and fixed income mutual funds, which is the Income Plus Arbitrage Fund. What is this all about, and how should you go ahead and plan your emergency corpus? Joining me now is Mohit Gang, the co-founder and chief executive officer of Moneyfront. Mohit, it's great that we're having this conversation because incidentally we'd had that conversation about savings bank accounts. So let me start by asking about arbitrage funds. Just to set the context, I think that would more than anything else, because this is a category that is in the equity category, equity taxation, and it has gotten a lot of attention because of the change in taxation. So how does it work first?
Okay. Hi, Alex. Always a pleasure to be on your show. Look, arbitrage category has become immensely popular. More so after the 2023 changes in debt taxation. Since the time debt has become completely taxable, previously, if you recall, Alex, debt funds were taxed with indexation. After 3 years, you could have claimed a long term capital gains taxation and could have adjusted indexation against it, right? But that's no longer valid. And since the time debt has become completely taxable, I think arbitrage as a category has become immensely popular because it gives you equity taxation advantage. However, the return profile of the fund is more debt-like. When I say that, it means that arbitrage funds are completely hedged positions. They don't take any long calls on naked equity, which means there is zero long equity exposure. Whatever equity exposure they have in the portfolio, it's completely hedged, right? So clients don't have any relationship with the market movement or the index movement. Yes, market volatility can impact arbitrage returns and the interest rate movements can impact arbitrage returns, but it's a pretty safe bet to go for if you have a holding period of 3 to 6 months and beyond that, then yes, it's a great category to be in. The tax advantage, as I said, if you hold it for over a year, you get 12.5% long-term capital gains taxation, and
Yes.
less than a year, it's categorized as short-term, which is 20%. So
Okay.
equity taxation on a post-tax basis gives you a much higher return than any other debt, short-term debt fund like your liquid, overnight, ultra short, and money market. So if you
Okay.
compare with these categories, then it's a great choice.
Okay, so a couple of follow-ups then in that. When we look at the way that these arbitrage funds are constructed, is there at all any debt or fixed income component in these arbitrage funds? And when you redeem the units, how quickly do you get your money?
Okay, fair questions, Alex. I think in any arbitrage fund, there is a significant debt composition. So typically, an arbitrage fund will have, let's say, 65 to 75 odd percentage of arbitrage positions, which are the positions which a fund manager has been able to identify where he thinks he will make a slightly higher return than the debt returns or the short-term debt returns prevalent in the economy. However, no fund manager in any kind of market format can typically figure out 85-95% of the portfolio completely into arbitrage positions. So they go ahead with 30 to 35% debt position in the portfolio. That portion of debt could be short term, medium term, or even long term in some cases. But most of the fund houses prefer keeping that debt in ultra short debt instruments or call money market, so that they can immediately deploy it either in arbitrage positions, or they can use it for any redemptions proceeds which they have to pay out for.
Okay.
And the redemption cycle for arbitrage funds is T plus 2 days, T plus two
Ah.
business days, unlike a debt fund, which is T plus one business day.
Okay, so that's an important point to bear in mind. You might treat it like a liquid fund, but it's not, obviously not a liquid fund, where a liquid fund or an overnight fund, also correct me if I'm wrong, Mohit, is available to you for redemption the next day. Is that right?
Yes, it's available to you. If you redeem today before the cutoff time, then the money is available to you in your bank account the next business day, for liquid and overnight and any kind of debt funds, but not for arbitrage.
Okay, so that's an important point to bear in mind. I also want to talk about that 65% threshold that you mentioned. That is what takes you above the equity category for equity taxation, right?
Oh yes, absolutely. Typically, because all these positions are hedged, there is no, as I said, there is no naked equity exposure out here, but that is required to give them an equity tax advantage.
Okay, so we've now established what arbitrage funds are, and we talked about why they are being preferred by a lot of people, because uh, liquid funds now get taxed at the slab rate. So a lot of people have shifted to arbitrage. Of course, there are disadvantages. As our viewer has so rightly pointed out, accessibility or liquidity of funds is a very important factor to bear in mind. But let's talk about this income plus arbitrage category, where the mutual fund industry has floated more products to take advantage of the change in the tax rules. Why is this a category that is seeing more interest, Mohit?
Okay, this is a very fascinating category which has evolved, I would say, in last 3 4 months, Alex. There were funds in this category previously, but they weren't being managed very actively, or even the fund houses weren't focusing on this category. But post the tax changes in the last finance bill, the ETFs, the fund of funds, and everything. Previously, the taxation was at slab rate. They've now become, you now get long-term capital gains taxation on that after completing 2 years of holding period. So post 2 years, the gains are LTCG and taxed at 12.5%, which is a significant change. Previously, the FOFs, or the fund of funds, were categorized as long term. Basically, they were categorized as debt funds for tax purposes and were completely taxed at marginal rate, right? So that advantage wasn't there in holding any kind of FOF or an international fund or so on and so forth. So now, after the change in taxation, this category becomes extremely useful. So out here you will have equity composition, sorry, not equity composition, you will have arbitrage composition, which is greater than 35 odd percent in the portfolio. So that and the debt composition is the remaining part of the portfolio. So then finally, the if you hold the fund for 2 years plus, you get added advantage of 12.5% taxation.
Okay, so important to understand the limits here. Whereas in the arbitrage fund, they had to have the 65% limit for arbitrage. In this income plus arbitrage fund, they need to maintain a 35% at least of arbitrage to get that 12.5% long-term capital gains tax advantage after 2 years, right? If they're not maintaining that, then they would be treated as a debt fund, correct?
Yes, absolutely. They have to maintain above 35% arbitrage allocation to get that tax advantage.
Okay, so let's talk about this fund of fund structure, because, and rightly so, a lot of people also point out that the disadvantage of a fund of fund structure is that you get charged twice when it comes to your expense ratio, right? Because you're investing in a fund that invests in another fund, and obviously that underlying fund is going to have its own cost. So you're bearing the cost twice. How does this work, Mohit? And is it a significant disadvantage?
Alex, yes, prima facie, it is a slight bit of disadvantage. However, the advantages by virtue of taxation and what you are getting into finally outweigh the tax disadvantage, or not the tax disadvantage, sorry, the TER disadvantage, if you may call it so. Look, SEBI has stipulated rules for FOF, and SEBI specifically says that for any fund of fund structure, the complete cost of the fund cannot be more than double the weighted average cost of the underlying funds which are there in the fund of fund, right? To break it down, let's say if you have a fund which is income plus arbitrage fund, the typical composition out there is you will have a corporate bond fund, and you will have an arbitrage fund as the underlying. So the portion of the fund is divided between these two categories. Now let's say the corporate bond fund runs an underlying exposure, underlying TER of around 60 bips, and the arbitrage fund runs an underlying TER of, let's say, around 40 bips. So your weighted average cost of these two is the underlying cost of the fund, and the FOF is then allowed to charge something over and above to maintain the expenses of the FOF. So FOF, let's say the weighted average cost is 50 bips. So the FOF can typically go and charge anywhere up to 1% on this fund, but you will find most of the FOFs in this category charging 10 to 20 bips over and above the underlying cost. So the expense ratio which a viewer sees when he goes online is only the expense ratio of the FOF. The expense ratios of the underlying are not given in any of the websites which you go and check out when you check these funds.
So let's give an example just so that people understand this, right, Mohit? If you were to invest 100 rupees into one of these schemes, based on what you have described, you would have in a direct scheme 50 basis points of a cost. How would you work that out? 50 basis points, which would mean 50 paise on that 100 rupees. So, but how would you work this out?
Okay, let's take a very simple example. Let's say you have a fund, and let's take an example. Perhaps you can take an example of a DSP income arbitrage fund. So they will have a DSP banking and PSU fund as an underlying, and the DSP arbitrage fund as an underlying. Okay. Now the DSP banking and PSU fund would have an expense ratio of maybe around 28 to 35 odd bips. I'm not exactly aware of the numbers, but yeah, around that band. And the arbitrage fund will have an expense ratio in the similar range. So and let's say the fund is investing 60% into the banking and PSU fund and 40% into the arbitrage fund. So the weighted average cost of the fund, after giving the ratios in the proportion in which the fund is held into these two funds, you will find the weighted average cost to be around 50 bips or 40 bips, let's say. That is the cost of the underlying. Now, the FOF will charge another 11 to 15 bips, or my sense is around 20 bips, as the expense ratio for running the fund. So that's the running expense of the FOF. So the total cost for the investor is 20 bips of the FOF and the underlying cost of around 38, 40 bips. So that's your total cost. And this is how you have to see it.
Yeah, so 60 paise on 100 rupees is the cumulative
Yes.
that you would pay. And remember, though, that this is direct. On regular, you would have a higher amount. It could maybe go to 80, 90. Is that fair? 80 to 90 paise, Mohit?
Absolutely. I think that's the band. On regular plans of these funds, you will typically end up paying around 80 paisa to a percent. And on direct plans, I think the typical expense ratio would be somewhere between 40 to 65 pips.
Okay. Now,
Depending on the fund.
how does that compare? That obviously, and you've already pointed out that liquid funds and debt funds to that extent that are on the shorter end of the spectrum would be anywhere between 35 or thereabouts paise, right? And I'm talking about direct here. Arbitrage is also a similar kind of a treatment on. So you're paying more for investing into these schemes, but is the trade-off acceptable? And how does that work? You mentioned the scheme that you mentioned invests in a corporate bond fund, which by my understanding has a duration that is longer than your liquid fund, which is effectively a very short-term paper that it invests in, or an overnight fund, which invests in CDs and CPs, which is certificates of deposit and commercial paper and very short-term paper at that. So how does that have a bearing on the return expectations that you might have?
Alex, look, I think one has to be very clear. If you're investing in this category, then the holding has to be over 2 years. If you're investing for less than 2 years, then this category does not make sense at all. If you're investing for a tenor which is less than 3 to 6 months, then you are better off in a liquid or a money market kind of a category. If it is over 6 months to, let's say, around 2 years time frame, then arbitrage is the category for you. And if it is over 2 years and you really want to park safely, then income plus arbitrage is the category for you. Because what happens is, after 2 years, when you pay only 12.5%, let's say the combined yield in this portfolio, the YTM of the corporate bond fund here, would be somewhere in the range of, let's say, 8.5, and the YTM of the arbitrage fund would be somewhere in the range of around 7.5. So the weighted average YTM of the fund would be somewhere in the range of, let's say, 8% or 8.15% or whatever it is. But post tax, after 2 years, when you see, your returns are significantly enhanced because you're paying only 12.5% as compared to a normal standalone arbitrage where your YTM would have only been 7.5 and you paid 12.5. So you're better off in this case. Or a normal debt fund where your YTM was 8.5, but you paid full 30% tax on that. So on a post-tax basis, this category completely stands out. If you hold it for over 2 years, then the expense is also worthwhile. But otherwise, definitely not.
So then that's an important point to raise, and that comes up to the argument that I pointed out at the start of the program. Then Mohit, is it appropriate to use this as part of your emergency corpus? I'm sensing the answer to that is no. Because despite the tax advantages that you have, if you're not holding for a period of 2 years, and chances are in an emergency corpus, you would want to have more liquid assets. Does this qualify?
Absolutely, Alex. Bang on. You can't be further away from truth on this one, that this is not the category for emergency parking. Look, we've repeated this time in and time out again, and I'll again put the hierarchy out there. If you really want to play emergency corpus, then 3 to 6 months of your salary has to be in a sweepable FD as a first thumb rule so that it can be withdrawn overnight. Or if you believe in the concept of Insta Cash, which is a mutual fund instrument, but again, the limits are pretty low out there. So you can do that. And then post that, once you have parked your money in sweepable FD, then comes liquid, overnight, or money market instruments. After that, you have an arbitrage category where you park funds which are meant for beyond 6 month parking or beyond 3 month parking at least, if not six. And when you are sure you want to do a fixed income allocation, you don't want to take chances in equity market, but you have a pretty decent horizon with fixed income, which is say 2 years and above. That is when you get into an income plus arbitrage category. It is not an emergency replacement. It is not a fund for parking. It is a fund for fixed income investment as part of your portfolio allocation.
Okay. Now, just to drive home one last point, since we've established that, and you've pointed out how much you need to keep in your emergency corpus as well. So that question is answered. When it comes to the return expectations on this, you pointed out 2 years as well. The last 1 year would look really good for this income to arbitrage or plus arbitrage category because you've had a declining yield situation where interest rates in the system have fallen, and so fixed income as a category looks better. Is it always the case that you can expect that? The answer to that would be no, right? Because once you have another rate cut maybe, or another 2 rate cuts, there's probably going to be a pause and then an increase in the rate cycle the next time. And when that happens, should you adjust your return expectations as well?
Alex, this is a very fascinating category. Every mango in the basket of this category is a different variety altogether, right? As many varieties of mangoes you know, that's the kind of varieties you find in this category. So there is, let's say, an Axis fund which will have underlyings of at least 10, 12 funds, and not just Axis Fund House, but other fund houses as well, right? There are funds which will have underlying as arbitrage plus banking and PSU fund, funds with underlying as corporate bond and arbitrage, funds with underlying as gilt and 10-year constant maturity and arbitrage. And then there is an ICICI fund which has even equity 10 to 12% as underlying, some REITs, some cash and gilt and everything, right? So while an investor picks this category, he has to be completely aware what is the underlying. If he wants a long bond or if he wants a long duration bond as an underlying to play the interest rate scenario, then he has to pick the fund accordingly, which has underlying exposure of gilts. If he wants a slightly aggressive band, then he can pick something which has a little bit of an equity. If he wants a pretty moderate band, then he picks something which is a corporate bond and banking and PSU as an underlying fund along with arbitrage. If you want a very conservative band, then you pick something which has high quantum of traps and cash as underlying with low duration debt funds as underlying. So one has to be extremely cognizant of what he's picking up. The varieties are far and very, very different.
Okay, last question, a quick answer to this one, Mohit. So this would fit into your overarching fixed income allocation, I would think. And the second question would be, based on what you have described, what do you like in the category, and are you recommending that people go and invest in this?
is a pretty complex category for someone to understand and fathom. Honestly, I'm not so much of a juggler when it comes around mixing and matching various kinds of debt instruments for that extra 30, 50 bips kind of this thing with a 2 year kind of horizon. Again, it becomes a little sticky around, so that you have to hold it for that kind of an horizon. I would go with a simple, plain, vanilla, long duration debt fund right now. And for parking, I would go with arbitrage. I'll keep the two categories pretty separate because arbitrage, any which ways, gives me an equity taxation advantage. But someone who wants fixed income as a core part of their allocation for a pretty long term, then maybe yes, this could be a category. But again, one has to understand the nuances of the FOF very clearly before getting into this.
Okay, fantastic. Mohit, thanks so much as always for taking the time. Pleasure speaking with you.
Thank you so much. Thank you. My pleasure.